Hi there, everyone. Welcome to Chart This with Dave Keller. It's Wednesday, February 12th, and I am your host, Dave Keller, coming to you from a beautifully sunny but still quite chilly Redmond, Washington. The snow is slowly melting off of our property, and we're going to be in the 40s and rain over the next week. So I would assume that will be it here pretty soon for the snow, the residual snow that's remaining here. Bit of a frosty feel to the markets here as well. Hot inflation data this morning, the CPI coming in a little higher than expected, weighing on risk assets, while the NASDAQ did narrowly eke out a positive day, up slightly from yesterday, about 6 points for the NASDAQ composite, the S&P and the Dow in the red. Today, we're going to talk about some of the different major averages, talk about the S&P, but also the NASDAQ 100, the Russell 2000. When we get to the chart review portion, we'll talk about some of those different patterns and how they're related to one another. Most sectors, almost all the 11 sectors, finished in the red today. So this was a bit of a downer with a weaker breadth, weaker performance for some of the top names, showing further weakness. Again, but still no breakdowns, right? Still no significant breakdowns with some of those key names, just on the weaker end of a consolidation phase, I would argue. Let's get to the market recap and all the charts as we go. As a reminder, I can see questions that you're putting in on any of the places we're live streaming on Facebook, LinkedIn, YouTube, and X. Thanks so much for tuning in live. Those of you that are, you can ask questions all along the way. At the end of the episode, I'll grab a question or two. Anything we don't get to, we'll put in the mailbag, which we will open up for a Friday all mailbag episode. And I appreciate all of your questions. Looking at the major averages today, again, I mean, the story, big picture, was inflation data this week. Earnings still coming out, and you'll see stocks like MGM having a nice gap higher in the post-market trading session, the after-hour session. But generally, this is, we're kind of through the bulk of earnings, and now it's going to be more about some of the economic data coming out. Inflation today with the CPI, tomorrow with the PPI. And if you read the headlines about the CPI, it's just higher than expected. And so what's happened today, you'll see rates going up, you'll see risk assets coming down, and some general kind of expected behavior given the fact that inflation is a little more. As you remember, I mean, the general trajectory to Fed rate cuts, the general bull thesis for stocks going into the end of last year and into the beginning of this year was that inflation was kind of not a problem anymore, right? So I have this Goldilocks scenario where inflation coming down to reasonable levels, but we're still not down to that bogey of 2% annual. The CPI is still coming in around a 3% annual number, which is, as we all know, higher than 2. So it does bring into question, at what point does inflation come in higher than expected to the point where the Fed needs to take additional action, or the Fed is seen as impotent and unable to, manipulate rates and manipulate market behavior to their will, bend them to their will of rate policy. Having said that, NASDAQ composite, the best performer, still just up slightly, and the NASDAQ 100 was up about 0.1%. So those were essentially flat for the day. The S&P down about 0.3%, finishing the day just below 60.52, and the Dow Industrial is down 0.5%. Mid caps and small caps all down as well. And the small cap S&P 600, the worst performer, only down 1.3%. But again, that return of small caps that I try to ask every guest about when I bring them on my podcast, still waiting, right? We're still waiting for that run of small cap outperformance. I would say from a technical perspective, still underwhelming, as we'll see in a short while. The VIX moving slightly lower today. We're at a 15 handle, so we're just below 16 today at the close. The volatility conditions, the MOVE index, which is like the VIX for bonds, credit spreads, which look at high yield debt and what sort of premium those are trading at. They are all sort of in low volatility, low risk. Things are kind of good types of ranges. No real red flags from any of those at the moment. All right, bond markets, quite a bit of movement here, and the inflation data came out a little higher than expected. Bonds ended up selling off when the session opened. You can see interest rates, which are the top part of this, moving higher. So the 10-year yield finished around 4.64. The long bond is above 4.8%, around 4.84, and the 5-year point is just below 4.5%. The TLT, which is a Treasury bond ETF, long duration bonds, down about 1.4%. And so what's happened, I did grab the chart of the 10-year yield because we did look at it yesterday, so I want to update you on what happened. But as we've been talking about, right, bond prices have been in a downtrend, lower highs, lower lows. And what's happening is most recently we're coming off of an upswing in bond prices. And the argument is we're at the upper end of this channel. Do we now have the next leg lower? Today, that's kind of what's happening. You're seeing the TLT pull back from trendline resistance. The 10-year yield is bouncing up off of trendline support and trading back to the midpoint of that trading range. Dollar index, essentially no change from yesterday. The UUP was basically flat for the day. Looking at commodities, overall not great, but it depends on where you're looking, right? Gold prices were slightly higher. Silver and copper prices doing much better. The copper ETF was up almost 2.5%. Crude oil prices moved lower. And so the DBC, which is a broad commodity ETF, but definitely more skewed to energy than anything else, basically traded lower through the course of the day. And energy, which had been a top performer at times here earlier in the week, back at the bottom of the list. And as you'll see from the market carpet, the heat map, bright red in the energy sector. So sort of continuing to underwhelm. Cryptocurrencies, though, while equity indexes drifted lower and tried to regain, a positive win, but most of them finished down for the day. Cryptocurrency is actually doing quite well, so a bit diverging from the equity indexes today. Bitcoin currently around 97,560. That's up about 2%. Ether prices just below 2,700. That's up about 3%. You can see that all 10 of the top coins tracked on the stock charts platform, all in the green today. All right, looking at what we call the sector breadth, or looking at the 11 S&P sectors, how many were up, how many were down? It wasn't great. Communication services is your top performer, but only up slightly, about 0.1%. Consumer discretionary and consumer staples were basically flat for the day, just down barely, slightly, pennies from yesterday's close. On the downside, energy, definitely the worst performer, and some of the latest tariff headlines look like they're going to weigh on energy stocks pretty good. The XLE was down 2.4%, by far the worst performer. Real estate and materials round out those bottom three performing sectors. All right, down here, looking at breadth, on stock charts, we can track U.S. Indexes and looking particularly at advancers versus decliners. As you can see here, depending on what index you looked at, it was a kind of rough day to a very bad day, right? The NASDAQ composite, 55% of stocks were down. The S&P 500, that's 68% of stocks were down. But look at the small cap index, 82% of the S&P 600 members were down today. So you're definitely seeing a small underperforming large, which has been a pretty persistent theme here for the last 12, 18 months, continuing to happen on a day like today. And the closer you get to kind of large cap growth, the better you did. Although overall, this was definitely a bit of a distribution day for risk assets. Kind of mixed results here for the Magnificent Seven stocks. I did a video for Stock Charts TV earlier this week. I do a weekly show there, usually every Monday, but sometimes Tuesday it'll come out. But that video was talking particularly about the Magnificent Seven stocks and bucketing them into three different buckets. I would say the days of the Magnificent Seven and Friends being one group of stocks that are kind of doing the same thing. That is not the reality here in February of 2025. You have some names that are doing quite well, like a Meta, the most obvious example, continuing to make new, all-time highs week over week. Then you have a group of stocks that are kind of in choppy sideways mode, ones that have pulled back like Tesla and Apple that are struggling quite a bit. And then you have sort of these question mark names like Alphabet that are showing bearish divergences or kind of pulling back, but not breaking, right? Kind of holding the 50-day moving average. And so I would encourage you to think of this as a kind of a diverse group all of a sudden of very different technical profiles. For today, Tesla actually doing the best, up 2.4%, although granted, that's coming off of a pretty a pretty strong run of underperformance. Netflix up 1.9%. Apple also up 1.8%. On the downside, Amazon was down 1.7%. Nvidia down 1.25%. What's happened with Nvidia, by the way, is we've traded up to that congestion range that we saw in November, December, January. We broke down on the DeepSeek AI news. We kind of traded back up, but now we're stalling out in an attempt to get back into that range, so that support and resistance range, that consolidation zone, all of a sudden serving as a bit of resistance for NVIDIA as it's trying to regain those levels from earlier in the year. Let's look at the market carpet, a heat map style visualization. Again, I do see some questions coming in. Thanks so much for those. Keep them coming. We'll grab one or two before the end of the episode. All right, looking at the market carpet, and again, I mean, at a high level, I'm immediately drawn to some of the negative movements here, and I'm seeing that in technology with Oracle, ServiceNow, Arista, Micron, all having pretty rough days, down over 2%. All of those, some of them much more. Certainly, energy looking pretty rough. And what's funny is energy, I mean, has had a bit of a resurgence here recently. But if you look at the average, I mean, if you just pick a random S&P energy stock, it doesn't look great. I mean, it just doesn't, right? I mean, like DVN is, making a higher low, but it's still way down for the last 6 to 12 months. And I think that's the reality for a lot of these energy charts. From a technical perspective, most energy stocks look at best like kind of and that's not great for the group, and at worst, pretty distributive. Also noting, I mean, again, just kind of every sector seems like they have some names that were down a pretty decent amount. One thing we'll talk about today are some of the financial stocks. I think I grabbed Cincinnati Financial as an example, but some of these names actually were remarkably strong September, October, November of last year, just making nice headway to the upside, outperforming and starting to look like financials were going to be the next big thing. And some of these, granted, are still doing quite well. Like a JP Morgan is still, in a primary uptrend. Visa, MasterCard looking pretty good. But a lot of the regional banks coming down here recently. After earnings, you're seeing some further distribution in some of those names. What else stands out to this? I mean, I would say consumer discretionary, right? I mean, look at on a day like this where it feels like some things were down quite a bit and the breadth was certainly negative, which means the average stock was down. Look for the things that sort of bucked that trend and went positive. And I'm noticing in things like technology, Apple stands out, Intel coming in the green. Looking at consumer discretionary, Booking.com and some others, which are actually bouncing off after a recent pullback. Booking got down to around 4,600, 4,650. And now bouncing higher back toward 5,000. Tesla is still not a good chart. I'll be honest to tell you, it seems like a nice move being up 2.4%, but you got to remember that this is still a trend that has overall been fairly weak. And you can see elsewhere in here, looking at consumer discretionary, right? Home builders stand out. Lennar, DHI, NVR, these things were all getting dinged. And I mean, that rates going up is not great for home builders. I mean, I would argue that it's probably especially not good. And if you think about the chart of the 10-year and you flip it over, that's what's happened to home builders, right? I mean, the argument for home builders kind of last summer, last fall was the fact that rates were coming down. All of a sudden, homes are more affordable. Great, opportunity for home builders to thrive. But since September, which is when the 10-year yield kind of bottomed out, you're seeing home builders, trending downwards over that period. I'm also noticing like Home Depot, which is one of the three largest stocks. I think it's third after Amazon and Tesla. But if you look at the others like Home Depot, Lowe's, I mean, these are stocks that are not looking pretty good. I mean, Lowe's is actually making a series of lower highs over the last 4 months. So certainly in a distribution phase and heading lower. So, I mean, looking at this, I mean, I think this summarizes in many ways my concerns with this market right here. I mean, it's like the trends in these stocks, some of them are quite negative, right? With like home builders as an example of that. Some of them aren't bad, but they're just not good anymore, right? I mean, I think charts have gone from exceptionally good to kind of good. They've gone from kind of good to okay, and they've gone from okay to broken. And that has been the drift of kind of the technical configuration of this market. And I think the best way to measure that are in breadth conditions, which have been rotating lower, right? I mean, we're less than 50% of S&P stocks above their 50-day moving average now. We're not quite there with the percent above their 200-day, but we're getting close. We're less than 60% along that metric. Advanced decline lines, failing to make new highs after October, November. So, I'm definitely feeling a rotation here, if nothing else. All right, let's look at the charts. Getting to the chart review portion of the show today. S&P 500 again, sort of remaining in a stalled out kind of consolidation range. This green shaded area, by the way, is the gap from December, right? So mid-December, we had this little island reversal where we gapped higher, and then gap back down. And anytime I have a gap on the chart, I usually draw a rectangle like this just to highlight that range and just keep an eye on that range, because it usually will serve as support or resistance. Often I think of it like a pivot point. It's an area where the market tends to find meaning, tends to move around. And so by keeping an eye on those levels, I find I have a good framework with which to think about further price action. If you look since that gap, most of the last 2 to 3 weeks have been within that range, with a couple of days where we went below. But overall, this is an S&P definitely not going higher anymore, but it's not going lower, right? It's not breaking down. It's not breaking down through levels of support and then failing to regain them. Last time was in second week in January, we bounced right back up. So overall, this is not, an uptrend anymore, but it's not really a downtrend. It really is that third direction going sideways. We're kind of settling into a pretty clear range, 5850 to 6100. I mean, at this point, I feel like, if you have to rate the S&P buy, sell, or hold, it's kind of a hold, right? It's kind of a neutral rating. And I guess what I would do if I were you is think about what would this chart do to make it more of a buy rating. Like, what would you see from this chart to say, okay, I really need to be invested? For me, it's getting above 6,100 would be kind of the signal. Now, the other side to that is we get so far down, we get down to like 5,000. I'd think, boy, the market's down a ton. I'm probably going to want to accumulate just because we're probably going to recover these at some point, and we're not going to zero. But for now, it's just sort of not going up. It's stalled out. I compared the S&P chart yesterday to a power on stall, and I would say that. So at this point, I do own plenty of equities. I do have kind of the risk on trade on. Things that are breaking down, I'm unwinding, but things that are holding up, I'm kind of happy and comfortable with that. I'm not seeing reasons to unwind those positions yet. I'm not seeing reasons to like double down and get aggressive on the upside. It feels like limited upside for the broader averages. That's how I would describe the conditions right here. Now, the NASDAQ 100, kind of an interesting chart because it sort of focuses in on that large cap large cap growth component of the markets. I've drawn a rectangle just showing the behavior of the QQQ after the elections, right? So we had the gap higher after election day. You can see we went higher about another day, and then we ended up pulling back. We ended up making a new high with the QQQ getting all the way up to 540. And then from there, we've just sort of been range bound. We've gotten down to that gap day at QQQ 500. We've gotten back up to test the all-time highs from mid-December. We have not broken below this gap. We have not broken above that resistance. So similar to the S&P, I would say the NASDAQ 100 is in a range as well. Below 500, I would argue, is pretty negative. And even worse, I would say below the 200-day, which is around 485. The 200 days held a number of times on some pretty painful pullbacks, particularly that July 24 pullback kind of famously hit the 200-day, had this nice bullish candle at the 200-day, which led to a decent recovery. But again, I mean, we're not going up at the moment anymore. The moving averages are sloping higher. That's good. We're not really failing to hold the 50-day, which is good. But we're not breaking out, right? We're not getting above resistance. So I continue to see this as a sideways sort of equilibrium. The market's telling you the Qs are worth around 520, and we're just kind of overshooting and undershooting that equilibrium price. And now you wait to see which way we break. And if we break above 540 on the Qs, that's a pretty bullish development. And I would argue you probably want to participate in that uptrend as long as possible. We start breaking below 500, I would say the Qs are a pretty broken area of the market. Now, one interesting note at the bottom, I'm doing the relative performance of the MAGs versus the QQQ. And this is just to show how the Magnificent Seven really outperformed the NASDAQ 100. The NASDAQ 100 is really weighted toward those stocks, but there's also about 95 other names that are all kind of big cap growth names in technology, communications, consumer type of areas in the market, among others. But this is looking at the mega cap growth trade versus everything else. And you can see how the Magnificent Seven were dominating until kind of mid-late December. And from there on, the MAGS ETF has actually been underperforming the QQQ. So the strength in the Qs, the reasons why it's holding up, are not because of the Magnificent Seven. It's the other things that are actually doing okay. And we saw that with the fact that the breadth in the NASDAQ 100 is way better than the breadth in the S&P 500. And it's not the Magnificent Seven. It's not Tesla that's helping that particular ratio. It's some of the other names in there. So again, I would say this is very much a rotational environment. Speaking of rotation, by the way, I did interview Julius DeKempener for the Market Misbehavior podcast. Just released that about an hour ago on our YouTube channel. So if you're interested in sector rotation, if you've used the RRG visualization that he designed, or if you're not familiar with that way of visualizing sector rotation, it was a really good discussion. He talked about how he's using the RRG now, focusing on multiple timeframes to identify some strong sector opportunities. Also talked about consumer discretionary as a potential area to focus on based on how it's rotating on the weekly RRG. So I would encourage you to check out that interview. It was actually really a really fun one. And again, just posted on our YouTube channel earlier today. So you see the S&P 500 kind of stalling out below 6,100. We see the NASDAQ 100 stalling within that range as well. Now look at the NASDAQ, or excuse me, now look at the Russell 2000 small caps, and you can see how this looks a lot less awesome than those first two, right? While the S&P is sort of near all-time highs around 60, 50 or so, while the NASDAQ 100 is sort of in the middle of that consolidation phase, Russell 2000 is actually, making a very clear lower high in 2025. We had a down move to the 200-day moving average, which has served as support a number of times. We had this bullish divergence, which we highlighted, which ended up leading to a nice bounce to the 50-day moving average. But that's where the rally ended. The Russell 2000 ETF, the IWM, has stalled out right around 230. It's an interesting level to pay attention to, and just below or just above the 50-day moving average. So the small cap index unable to get above the 50-day, unable to push above 230. And so I would say at this point, that chart is a dangerous one. Right now, we're kind of settled in no man's land between the two moving averages, which is, not a horrible place to be, but not a great place to be, right? We're sort of below a declining 50-day and an ascending 200-day, which means at some point, one of those is going to break. And I would personally be setting alerts for IWM above 230. I would be setting an alert for IWM below 215, which would take us below the 200-day moving average, and also below the swing low from early January. And I would say whichever signal comes first, that's probably the direction of momentum that you want to follow. So again, while these charts are not horrible, they're not great anymore. What's good about the market in this sort of configuration, I think it provides a pretty clear playbook, because one of those, when you have something consolidating, one of those levels is going to break. You just patiently wait for which one happens. And I think that's probably where things are going to go next. And I wouldn't be surprised if they break out. I would not be surprised also if they break support and continue a bit lower. One of the danger signs I look for, and again, I was thinking of this chart after talking with Julius DeKempener yesterday, which is when we recorded the interview. We were talking about rotation, and you're not really seeing a big improvement in defensive sectors, but they're not horrible, right? This is the relative performance of utilities, healthcare, consumer staples, and real estate, the four most defensive out of the 11 S&P 500 sectors. And I would just point that while these are not in crazy optimistic relative performance runs year to date in 2025, none of these are underperforming in 2025. As a matter of fact, all of them have been starting to turn a little bit higher. And if nothing else, they're probably drifting a bit higher. So it could be early on with some sort of rotation to defensive sectors. To be honest with you, if rates go up a ton, that kind of often will weigh on this a little bit because the argument for some of these sectors is that you have a decent dividend yield. And if, bonds aren't paying a lot of yield, high yielding stocks end up being a much more compelling option. So higher rates may damper the optimism on some of these areas, but I'm certainly noting that the general trend and the relative strength of these sectors has been slightly higher. And I think this would be a definitely an important area to watch to see if you see further improvement. That is one of the big red flags I will look for, when assessing whether we're at a major top or whether a major top has occurred recently. It's whether you see investors rotating to more defensive positioning. I don't think we're getting there yet, but certainly starting to show. They're not underperforming right now, and I think that is something to watch. Here's the chart of the 10-year yield. We've highlighted this recently on the show many times just to show this general uptrend channel. I mentioned the September low, and this is one of the reasons why the charts of home builders don't look so great. is because from mid-September now to mid-February, mortgages have not gotten cheaper. They've arguably gotten a lot more expensive. Home builders felt like a really good place to be as rates were coming down. The 10-year yield's going from 4.7% down to 3.6%. But when we're going from 3.6 down up to 4.5, 4.6, 4.8, that's a lot less awesome for home builders whose job it is to build homes and then have people borrow a lot of money to buy them. So that particular dynamic is hurting at the moment. Now, what's been happening from a technical perspective, as you can see, the 10-year yield has pulled down to the lower trend line. Similar chart would be the TLT or the AG, which are trending downwards, and you saw a counter trend rally up to trend line resistance. The TLT is now pulling back from trend line resistance. I'll just show you that real quick. So here's like the TLT. If you draw a trend line using those previous highs, it lines up really well with that early February high. Now we're kind of rotating lower, and you can see the 10-year yield, we're kind of popping off of there. So, I would argue that the long-term trend, I think, is pretty clearly still rates going higher here, at least from a technical perspective. That makes a ton of sense. The yield curve continuing to steepen a bit as the lower end of the curve is being brought down and the long end of the curve is going back up. So we have a yield curve steepening. That's usually not great for risk assets when you've had a yield curve that's been inverted for so long and now comes back to a normal shape. And that's what we've experienced here in the last couple months. So I would say rates, definitely, this was a big move higher. And again, that's a reaction to the inflation data earlier today, but that's what can cause rates to go up for sure. We've highlighted the charts of NVIDIA and Alphabet. We've been following those. NVIDIA with the gap lower in January and now trying to regain this range that we established in the fourth quarter. Alphabet gapped lower on earnings last week. This is after making a new all-time high above 205. We gapped down and then continued to drift lower. And I think this is a concerning development that we've seen on the chart of Alphabet. I'll show you in a moment another technology name showing that particular pattern as well. These were charts that looked remarkably strong into the beginning of this month, but then earnings misses, gapping lower and trading lower from here. So from a technical perspective, what do you see? I see NVIDIA unable to get above its 50-day moving average this week. I see Alphabet flat out failing to hold it and continuing to drift lower. Those are not great charts. And when I talk about the Magnificent Seven being not so magnificent, the meager seven, the lag seven have been some great ideas I've received. Keep them coming if you have other ideas to call this broken list of broken charts. NVIDIA and Alphabet, I think, are perfect examples of some of those names that are struggling. Now, again, are these horrible end of the world doomsday charts? Like, they're not yet, right? They're still okay. And the weekly charts still look pretty good, but it's just in the short term, that's where we're seeing quite a bit of distribution. And long-term uptrends are often persisting because investors are buying in on weakness and buying in on the pullbacks, pushing prices higher. We're actually seeing investors not buy the pullback here. And I think that's is one of the things that is sort of standing out to me as I review the evidence. Just like Alphabet gapping lower after making a new high, you see the same thing with ServiceNow, which is down another 2.6% today. The problem today is that takes us below the January low. It also takes us below a big round number of 1,000. And you really want that kind of thing to hold because that's a good psychological level that a lot of investors will note. If we're failing to hold that, that really tells us that we're in the at the beginning of a distribution phase. I would also say, higher highs December, January on weaker momentum. That's the bearish momentum divergence we've highlighted on a lot of different charts. Here it is on ServiceNow going into earnings and disappointing coming out of earnings. Bank of America, not broken yet, right? We're holding the 50-day moving average. A number of financial stocks were down a little bit today. It's only down 1.25%. We're not too far below all-time highs at 48, but I would say we've certainly stalled out in an attempt to make new highs. The trend in the momentum, the trend in the RSI is definitely sloping lower as we're making that new high about a week ago. And so charts like this are not broken, but they're certainly showing signs of a stalled out uptrend and potentially a topping pattern, right? New highs on weaker momentum is definitely a red flag to look for. Cincinnati Financial here is a property casualty insurance name. And this is another one. Again, you cover up the chart after November, and this is just a remarkably strong technical profile, right? Higher highs, higher lows, above two upward sloping moving averages. But look at how all of that has changed in the last 3 months. We made from making, higher highs and higher lows to now lower lows and lower highs. We were above the upward sloping 50-day moving average. We failed to hold it and now failed to recover it this week. Yesterday, we had a gap higher, traded above the 50-day, closed back toward the lows, and today selling off even further. The RSI in 2025 has not been above 50 as the relative strength is underperforming. So stocks like this that start, have been very, very strong, but all of a sudden start to break down, and then the momentum just pivots big time to the bearish range is usually the sign of a broken chart. And the way you exit from this is kind of what we saw like in July of last year, which is all that changes. Again, we regain the 50-day moving average. The RSI pushes above 50, above 60. The relative strength starts to improve. So until you see that kind of pattern, I'm going to treat this as guilty until proven innocent. Now, what's happened today is we've traded down almost exactly to the 200-day moving average. That's the next potential area of support that you'd want to hold if you're bullish on a chart like CINF. Caterpillar is another one, trading to the lower end of the range today, back below the 200-day moving average. The last time we broke the 200-day, early January, we closed below it. One day only, closed right above there. So if you're all bulled up on Caterpillar, that's certainly what you'd want to be an ideal outcome for the remainder of this week, is regaining the 200-day moving average, because that held really well last summer into last fall. But we have failed to get to new highs. And I think what's the most damning part of this chart is the 410 level, which was where we stalled out in November, in December, and now again in January. So we're at the lower end of this kind of basing pattern. We break much further and you're broken, right? It's a broken chart on weaker momentum and relative strength, making a new 6-month low. That's not a good look. Energy stocks feeling some pain today. I just want to highlight the chart of Valero, VLO, and I applied a Fibonacci retracement framework here. So you can look at the April high of 24. You can look at the December low. We rallied up to the 200-day, and we also rallied up to that 38.2% retracement of the way back up to the April 24 high. Now we're testing the 50-day moving average. This could be a big bottoming pattern. It could be a complex, inverted complex head and shoulders is what you'd technically call that. But that kind of pattern is only bullish if and when we break above the neckline, which means this chart has to get above 143, which would clear the February high, clear these previous highs, clear Fibonacci resistance, clear the 200-day. And until and unless it can do that, this is a chart still in a primary downtrend, according to the charts. Again, failing to get to a new swing high is usually not a good sign, because that suggests that there's not enough buying power coming in to push us to a new higher high, right? To indicate that investors are willing to pay a little bit more. This is showing that investors are not really willing to buy a lot at the moment, and that is why the trend overall remains fairly negative. Final chart here, then I'll take a question or two. MGM. From a technical perspective, going in today, not great, right? We're making lower lows, lower highs. We're below two downward sloping moving averages. I would say gambling charts like MGM, pretty ugly. The reason why I wanted to highlight this, though, is because they just reported earnings, and aftermarket looked like they were actually gapping up pretty good. So let's see. Yeah, around 8.4% higher. So 37.26. We're kind of right in there. So aftermarket, it looks like we're trading up toward these levels, which means we're getting back to that November range, getting close to the 200-day moving average. So I would say with this chart, if we do get that gap higher tomorrow, which looks pretty likely, see if we're able to get additional buyers coming in, see if investors are optimistic and pushing the stock above the 200-day. If so, I think that deserves maybe a second look. But until that happens, I'm skeptical, because I've seen these periods where we try to get above the 200-day and fail. So I still see this as a downtrend until we can regain that. A gap higher tomorrow would certainly be a step in the right direction. Let's see if we can get above the November highs and get above the 200-day as well. All right, let's look at a question or two and then finish off. I'm sorry, I'm giggling looking at some of the questions coming in here. Let's see. Let's questions. Yeah, a number of questions here. Blind Owl, thanks for watching on YouTube. I guess I've gotten so used to 2 years of highs, having come back down to a new reality. I'm not 100% sure what you had a number of questions in there, but I would say, agreed. 2025 so far is a very different year, and I think that has actually happened a lot in recent history. If you look at the markets from November, December to January, February on the average year, it's very rare in the last couple of years where we've just kind of continued like nothing's different. That's, I think, a lot of times when you have a strong December, that's a lot of times what investors kind of want to think about. But I would say, so many times there's been a big change from the end of one year to the beginning of the next year. And I'm remembering particularly the strength in 21 led to a remarkably weak first quarter of 2022. A choppy, sloppy fourth quarter of 22 led to a pretty decent start to 2023. It's been pretty volatile, and it's almost like you flip the calendar and it's a completely different market. It reminds me, to be honest with you, is one of the things that I really value about seasonal studies, right? And I'm thinking of my interview with Jeff Hirsch of the Stock Traders Almanac. Talks a lot about seasonality, but you can't think of seasonality as January is usually pretty good, May's pretty bad, October's pretty bad, that kind of thing. I mean, those are real generalities. Look at post-election years, look at election years, look at pre-election years, look at midterm election years, look at some of those trends, look at what happens when rates are going up, when rates are going down. And if you start to look for those similarities, you often have a bit of a playbook to work with, or at least it helps you understand how the changing of the year from the fourth quarter to the first quarter can often bring dramatically different results. This year, of course, we're dealing with some aggressive policy changes from a Biden administration to a Trump administration. I mean, this is a new high or a new low, depending on how you think about it, in terms of the amount of changes that we're seeing in January, February. But again, that's what I love about looking at charts, is it's a great way to cut through all of that noise. You'll hear a lot of speculation about what tariffs could mean, or tax policy, or geopolitical issues, or whatever is going on. But at the end of the day, charts will tell you what is actually happening. Kuldeep, thanks so much for watching on YouTube. Can you please review Mondelez, MDLZ, as requested? Let's take a look. I don't mean to look at the big weekly chart. Let's start here. So Mondelez, right? So this is one of those rare. This is one of those consumer staple stocks that's actually starting to look kind of interesting. And the consumer staples sector, if you've been avoiding it, if you've been ignoring staples for a long time, I 100% do not blame you, because the charts have been absolutely disastrous. And if you compare the average consumer discretionary stock versus the average consumer staple stock, it's been lights out, consumer discretionary, with the possible exception of Costco, kind of big box retailers that honestly look more like technology companies than staple stocks. But the average chart in consumer staples kind of looks more like Mondelez, right? Like MDLZ. Now, what's interesting is you're starting to see a real improvement. I would say Mondelez is impressing to the point where I think it deserves a look for sure. Look at what has happened. Now, we finally regained the 50-day moving average after breaking below it in early October of last year. The RSI is right at 60, which means, we were below 50 from late September until just in the last week. And now all of a sudden we're breaking higher. One of the indicators I love to look at on a chart like this is something like MACD or PPO. And on the daily chart, you can see kind of noisy here, but certainly rotating in a more positive direction, kind of similar to some of these previous swing lows you identified after the stock was underperforming and started to improve. The momentum is improving. And overall charts like this, I think, are pretty compelling. The weekly chart of Mondelez is really interesting to me too, because the weekly PPO is very close to generating a buy signal. And if you look at some of these previous pullbacks that we've experienced, that ends up being a pretty decent time to reconsider, because when the weekly PPO finally signals, that's when it often is strong enough that the new uptrend is kind of persisting. I'm interested in the fact that names like Hershey's are gapping higher and rotating higher, and other names that we've highlighted in food products and other consumer staples groups. At a higher level, besides the fact that Mondelez is looking kind of interesting right now, is the fact that consumer staples are a pretty defensive sector, and these are stocks that have not done particularly well. And if these stocks are doing well, that probably means investors are selling other things, almost a rotation away from Mag 7 type of stocks, leading growth names, into some beaten down staple stocks, which are fairly defensive, fairly low volatility, and maybe represent an emerging area of leadership. Still maybe too early to determine with charts like Hershey's, but very much a group of stocks that I would be watching. Folks, thank you so much for tuning in live. Those of you that have done so, and if you're watching on delay on our YouTube channel, I appreciate you so much as well. Please keep the fantastic questions coming. We're planning an all mailbag episode on Friday of this week, and we love to feature one of your questions in our show. As a reminder, on the Market Misbehavior podcast, great interview with Stephen Kress of Seeking Alpha in the last week, talking about quantitative investing, quant models, and their new Alpha Picks product that they've released. Julius DeKempener just released earlier today, talking about sector rotation, growth versus value, large versus small, a lot of things to unpack using his RRG visualization. I would encourage you to check out those interviews as well. For Market Misbehavior, I'm Dave Keller. Have a great evening. And remember, it's always a good time to own good charts. Take care.